It's a great time for us to have conversations around the market. Market Watch, that's what you're watching. We have this conversation every Monday and Wednesday, talking about what is really happening in the market. First, we're taking a look at the oil and gas sector. 5 companies listed on the Nigerian exchange. They all carry a combined 5.1 trillion naira total debt. And about 3 of those companies are responsible for, say, 94% of the total debt. We're going to examine and going to tell you what is really happening with debt and oil and gas. It looks like they're 5 and 6. When you mention oil and gas companies, there's a lot of close affinity to debt. And then we're taking a look at what is happening with Dangote Cement, their 9-month results out. We're going to examine the result and find out whether it's a great performance, whether it's a good performance. You're going to find out. And this will give you an informed decision as to how to approach the market. And then on the final note, we're taking a look at the Nigerian banks. They've started releasing their 9-month 2025 results. All of these conversations is what we're going to be taking a look at on this episode of Market Watch, brought to you by Nairametrics Television. My name is Frank. And I've got with me Idika Ajara sitting next to me. He's the man behind the articles. And Mukhtar Mohammed, amazing gentleman, whose portfolio, I guess, always smiling because you interpret what's happening on the chat. So let's start with what is happening. Oil and gas sector. There's a close affinity to debt. What's your take about that?
For the oil and gas sector, I think you listed, you have about 5 of them.
Yeah.
And looking at their debt profile.
Oando and Seplat.
Oando and Seplat leading. I think they have about 94% of the total debt. Well, if you look at it, yes, it could be for strategic expansion. It could be out of liquidity pressure. So, especially looking at the sector, it's capital intensive sector.
Very true.
So, but as we go on, I think there are certain things investors should watch out for to actually determine whether it is maybe a liquidity pressure or it is required out of expansion. So, like, look at the debt to equity ratio, debt to asset ratio, and even, especially importantly, the interest coverage ratio. So these are the things you have to watch out for to actually know whether there is a problem or not. But give and take, I think, Oando, even without looking at them at that, at least has a it has a negative shareholders funds about 305 billion.
Yeah.
So that's equally telling that is a problem. That means he's owing more than what he owns, what the company owns. So one is a red flag there.
What's your take about all of these?
I can't but agree with what Indika just said. Just to add to it, maybe some other. If you're looking at a stock, sometimes you look at the liquidity ratio, the liquidity in terms of the cash at hand.
Yeah.
For these 2 companies that he mentioned, you realize that their cash at hand is very, very poor. What they even have is the debt is more than what they have, like he has rightly pointed out. Yes, you look at expansion. But if you look at what you have said about Seplat and Oando, since they have the 94% in terms of debt, if you look at those both stocks now, you may look at Seplat and said, okay, their expansion program is ongoing.
Yeah.
They've been expanding. They've been buying assets. They have been still buying more assets.
A lot of acquisition.
You could see that. If you look at Oando, yes, you said, okay, they did some acquisition. But when it comes to Oando and acquisition, it has never gone well. I remember Coconut Phillips acquisition.
Yeah.
All of us were excited about it that year. It didn't go well. They've done some acquisition now, and even also building refinery. I think trying to be in Trinidad and Tobago, something like that. They're also having refinery there. When you look at the acquisition, you could say it's a strategic expansion, like what Indika have said. But again, you now have to look at what he really pointed out, negative shareholder fund.
Yeah.
That for me is a big red flag. That's what differentiates him and Oando and Seplat. That negative shareholder holding fund is either you come to recapitalize or or you do maybe share reconstruction or whatever. to get back. But I think most companies, when they have negative shareholders from, they have to do a right issue, or just try to recapitalize. But when you look at Oando again, you look at the profit, you look at where the kind of gain they had last year compared to where they are this year.
Yeah.
You could see that investors are beginning to read those numbers and are definitely a pullback.
So if you look at the three companies, apart from the heavyweights controlling 94% of the 5.1 trillion naira debt, if you look at Aradel, you look at Itana and Total Energies marketing, you notice that they are responsible for 294%. What do you think that the high interest rates and how sustainable is all of this, especially with regards to the fact that most of these loans are to the financial sector? So is it putting the financial sector at risk, or what's your take in general?
Of course, when you look at the non-performing loan of the financial sector in their half year or recent, I mean, we've not seen so much of the third quarter result.
Very true. There's even one story that is even still regarding this oil and bank sector.
Yes,
oil and gas, that the headquarters was shut down. So there are lots of conversations.
So you see that that also is impacting negativity on the banks also because of this non-performing loan, and this was largely driven by the high interest rate environment. Now we are beginning to see rate cuts, so definitely we expect that the non-performing loans and the banks will be able to make the application. But again, when you look, this oil and gas company will be able to meet up their obligation. But again, when you look at that reduction in oil price also, that's also a big challenge also for the banks, because we are not seeing the kind of price we thought we would see.
Didn't they see didn't they see the what is it called, the oil benchmark? If
you look at Nigeria,
based on 2026, 2025,
that's what I'm saying.
2025
all those projected oil benchmark of 2025 was
into your loans.
Yes, it was $75. About how much is crude oil today? It's about $60-something. So it's about $65. So you see that even Nigeria did not even project well.
Probably.
So, but again, I think when you look at those two heavyweights, the kind of debt they carried, I think they are red flag for me. But when you look at these other ones, outside Etana, I think for me, Aradel and Total. For me, Aradel is still a gold mine. If you look at the kind of investment they have done and the debt to equity ratio, the cash at hand.
How about the exits that they experienced last month? There was an exit for Aradel.
Aradel?
Yes. Was it? There was an exit last month or last 2 months. One of their see, when you talk about exit, I was saying one of the exit was based on it's IPO from
it's a company, it's fund manager. I think one of the fund manager exiting it was that they have made so much profit. And again, there were people that even bought into it immediately.
Very true.
And since then, you have seen that the price have kept going up. So that tells you that there's more confidence. When you look at this report, you are more confident in what they are trying to achieve. For me, my take is I will go for Aradel any day. I will go for Total Marketing because, again, the strategic and their history.
Yeah.
Their 5 years history, their 10 years history, their 20 years history. They stand that Eternal Oil. I thought there was a time that they had this partnership with Dangote refinery. I thought that should boost their numbers. Unfortunately, we are not seeing that. But for now, for both Seplat, number one, I'm not saying Seplat is not good, but at this price of 5,000 something, how many people can afford that? How many shares can I buy? So
yeah, that's right.
Coupled with this report, then for Oando, I think it's a no-no for me now. Maybe Indica will acquire it for strategic. Indica is more a fundamental value investor.
Yeah, I think you've done justice to it. If you rank them in terms of risk-adjusted return, you are correct. Though if you do proper analysis on them, you see that Total Energies ranks first.
Yeah.
Because of its stability and liquidity. Then you have Etana PSC because of his, though he has a very small scale compared to those big ones. Then, of course, Arada. Then after Arada, you have Seplat. Then I think Oando is in terms of risk-adjusted return is the riskiest. So in that order.
Sleeping giant.
Yeah.
GT Coal, Stanbic IBTC, and EcoBank. Now, what do they have in common? They've released their 9-month results, 2025. And 2.7 trillion naira combined pre-tax profits. Green flag or red flag? What's your take about this? I'll start with you, Idika. You like the banks?
Well, that is a 2.7 trillion naira combined profit of the 10 banks. That is for half year 2025.
Yeah.
Though it's somehow a decline compared to about
9 months, not half year.
No, half year. We've not seen their 9-month results.
Yeah,
I think you're talking about their half year results. It's only, I think, only EcoBank, GTCO, Stanbic that have released their 9-month result. Then I think this one is on half year, and that's the report. That is 2.7 trillion combined. That is 10 banks.
Yeah, 10 banks.
I think
outside of Fidelity.
Outside of Fidelity, yeah.
Because
outside Fidelity. And they are saying, and if you look at this, it was a decline compared to half year 2024, showing equally pressure on the banks. I think the major problem there is not only, the major problem is the paper money they made last year.
Yeah.
It's no more this year. So, but at core level, the core operation still very well. Very, very solid. So when I mean cooperation, if you look at the net interest income after impairments, they still did very well. So I think it's still a good result. Maybe by the time they finish with their, we'll see the whole of 9 months results, we'll be able to know what is happening. But again, you know that most of them made huge provisions.
Yeah, very huge.
And that provisions might not be there for
9 months. Yeah.
Especially I know of Zenith Bank made provision of over 700 billion in half year against 400 billion they did in half year 2024.
So, if looking at the current price, do you think it reflects their earnings slowdown? Do you think it reflects it?
I still think there's still a lot of value because, again, if you like Indika always say, you don't look at one side of the result, you try to look at the result in general. Because if you are trying to look at one side, when you look at the impairment charges, the provision, you'll be so disappointed. You say, wow, these banks. Then if you look at the earnings per share within the last half year and this year, you also be very disappointed. But then he mentioned something, say paper money. You realize that earning per share was largely driven by that paper money.
Very true.
Now look at one thing all these banks has in common. These banks, you see that their core area, there's significant improvement in their core areas.
True.
In terms of loan and advancement to customers, income and investment in securities. Now, investment in security, they may have challenge now. We are going into a low interest window. We are going to a low interest rate window because if you see, let's say they invested in bond and treasury bill. Yeah. So we are going to get lower return this year. So how we then navigate that? And also, but when you look at their core areas, advancement in terms of advancement and loan, realize they are also doing well. And if what we are seeing is going by that the economy is recovering gradually, that means those customers, those businesses and customers will be able to pay back. So for me, their core area has been good, and the paper money has finally disappeared. And we are now finding the paper money in the others in the consumer goods sector. They seem to be benefiting from the paper money now. Remember, it was the other way around before. So that's why somebody will say it's turn by turn. So, but when you look at their
in context, for those who are watching who don't understand, just explain paper money.
Paper money should be explained better by Mr. Ndika because the one that called paper.
What he just said,
money.
what we're talking about, in 2023, 2024, because of the exchange rate volatility.
Very true.
And those of them have financial denominated assets, and the change there affected them when they repriced. So they made a lot of gains from foreign exchange gains. Like I said, that is what drove their results in 2022 and 2023. Now, in 2025, that thing has really come down. And, impairment, because I have to make provisions for the impairments based on the last CBN directives on forbearance. So most of them have written them off. And of course, definitely, when you reduce the foreign exchange gains and the impairments are increasing, definitely it will bring down their bottom line. But
on the street,
at that core level,
fantastic results.
Yeah, fantastic. When you remove the impairments, it's still okay. It's only that if you come down a bit, what they call non-interest income has really come down because of that, the absence of foreign exchange gain, which they had in 2023 and 2024.
Yeah. As a matter of fact, on the street, they call it audio money.
But again, the beauty about it is like what he said, most of them have made 100% provision for all these. I mean, it's more or less like when you say your book is clean.
Very true.
So we hope we start seeing the 9-month result.
Yeah.
Hopefully, we will now begin to project what will happen. But one thing is certain: some of those banks are still very, very strong. Liquidity ratio is strong. Their retaining recapitalization is not going to be a problem for most of them. So we might have those slow down in terms of maybe high earnings per share in the short term. But again, I still believe that, like Ndika said, if you are investing in the banking sector, if you remember what Warren Buffett will always say, he said the market take money from the impatient and give to the patient. So I think it's all about patience with the financial stocks.
9-month results. Dangote out. How do you see the results? 743 billion profit. The revenue 3.1 trillion. And all of this is against the backdrop of the decline in their production volume. What's your take about the results?
I like the results so much. I was just talking to Mr. Ndika. I said, I like the results so much. There's improvement in virtually every area.
It's Dangote.
Earning per shares up, profit after tax, profit before tax, net interest. So it looks very, very exciting. I mean, when you look at that result, it shows that a lot has gone in there.
True.
Again, like I always say, for the earning per share has improved by about 156%, Mr. Ndika, about 156%. That means that Dangote will be able to pay more to their investors this year. And that means if you have 157, even if Dangote had to just pay 50% of that income, that is huge. So, and then I like what I see. Remember, if you look at that result, 700 billion FX losses now reduced to 1 billion. That is huge.
Yeah.
That is very, very huge. You can't those numbers are really numbers that you really have to look at again and look at again and look at again to really know, well, is this real? But again, like you said, the cost of sale has really gone up, and we know why that is happening. Especially if their main cash cow still remain the Nigerian subsidiary. You know, the challenge, despite trying to improve by logistic, improving to using the CNG buses. But again, we also still have to look at that. Those CNG buses have not really come into full implementation in every area, so they just started. Yeah. So we'll begin to see the impact in their maybe year and then first quarter result for next year.
On the final note, Dangote Cement, what's your take about the result? And then what do you think investors should look out for going into the end of the year?
Like you said, you mentioned the growth in profit despite the decline in production volume. Well, that shows a strong pricing power because that means the reason for that could be the pricing power. Then, though apart from that, at least they were able to achieve sort of a cost efficiency, like he really mentioned, using the CNG trucks that equally reduce their distribution cost.
Yeah.
Now, yes, it is a good result. It is a good result, and like he really said, definitely investors expect more from them by the time they declare their full year results. I think in 2022 they paid a dividend of 20 naira.
Yeah.
In 2023 they paid they increased it to 30 naira. Then 2024 they maintained the 30 naira dividend per share, and it's expected with this level of growth in profit. Like Mukta already pointed out, investors expect more in terms of dividends, but overall it is a good result. But another angle, the risk factor is that relying on price adjustments to grow might not be that sustainable, especially if inflation continues to go down and then continues to go down, and you have more competition in the sector.
Yeah, true.
Yeah, it's likely to impact too on their top line and bottom line. So I think they should go in line with the trends. Make sure that you produce more and your pricing is competitive, but reliable, because what is driving the growth is pricing power.
Okay.
Apart from the little cost efficiency they have achieved using their CNG trucks.
You have said it all. And you've heard it from Idika, you've heard it from Mukhtar Mohammed, and they've said that, analyzed all the numbers and told you what is a red flag, what is a green flag. All this information is just for you to be able to have an informed decision on how to approach the market. That's why we have Market Watch, brought to you by Nairametrics Television every Mondays and Wednesdays. My name is Frank, and I'll see you on the next one. Make sure you stay logged because we do this every Mondays, Wednesday. Do have a great time and make sure you remain profitable. Cheers.